If you are buying stocks while a credit card is charging you 22% interest, you are not investing. You are standing over a bucket with a hole in the bottom, pouring in water as fast as you can, admiring your discipline, and pretending not to notice the floor is already flooded. That is not a wealth strategy. That is denial with a brokerage account. I have watched ordinary people do this for decades. They chase the feeling of intelligence before they build the structure of intelligence. They want the language of ownership without the sequence of ownership. They want to talk about the next great stock, the next ETF, the next coin, the next miracle. Meanwhile, the bucket is leaking from 5 different places, and every leak is collecting interest, fees, taxes, stress, and bad decisions. You do not get rich by pouring harder into a broken bucket. You get rich by becoming ruthless about the holes. That is the part people resist because it is boring. It is also the part that separates adults from amateurs. One of the great financial delusions is that wealth is mostly about picking winners. It is not wealth. For most people, it is about preserving pressure inside the bucket long enough for the waterline to rise. If your system keeps draining, your intelligence will not save you. Your optimism will not save you. Your market opinions will not save you. And your salary will not save you nearly as much as you think. When I look at the average financial life, I do not first ask what return a person earned. I ask where the bucket was leaking. I ask what invisible tax was chewing through the bottom. I ask how many decisions were made out of fear because there was no buffer. I ask how much cash bled out into interest payments. Bad timing, unnecessary taxes, and the social performance of looking like an investor before becoming financially durable. That is why most people can work hard for years and still feel as if they are running in place. They are not failing because the market refused to reward them. They are failing because they are attacking the wrong problem in the wrong order. The order matters. It matters because money is not just arithmetic, it is pressure, time, behavior, optionality, and the ability to avoid stupid decisions when life punches you in the mouth. If you ignore the order, every later move becomes weaker. If you respect the order, even ordinary decisions become powerful. I want to give you the sequence the way I actually think about it. Not as a cute checklist, as a leak map, because that is what your financial life is until proven otherwise: a bucket, a water line, a set of holes, a set of repairs, a set of choices that either hold pressure or waste it. The first hole is the one almost nobody wants to talk about because it does not make for an exciting dinner conversation. It is the cash hole. It is the fact that an astonishing number of people are one minor inconvenience away from panic. In the source logic behind this discussion, roughly 1 in 3 Americans had no emergency fund at all, and the median emergency savings figure was just $500. That is not cushion. That is a delay. It is not enough to absorb a real problem. It is barely enough to postpone one FE file site FE turn 13 file 0 FE. Now look at what that does to behavior. If your car breaks down and you have no cash buffer, the bucket leaks because you borrow. If your hours get cut and you have no cash buffer, the bucket leaks because you sell assets at the wrong time. If a medical bill shows up and you have no cash buffer, the bucket leaks because fear takes over and every decision becomes short term. People think an emergency fund is there to pay for emergencies. That is only half true. Its real job is to protect your judgment. I have no interest in pretending psychology is secondary. Psychology is one of the largest holes in the bucket. Fear is expensive, desperation is expensive, forced selling is expensive, high interest borrowing is expensive. The absence of a small cash reserve turns every surprise into a financial ambush, and then people wonder why compounding never seems to work for them. Of course it does not work. Compounding requires time inside the bucket. Panic dumps the water out. So you do not start by dreaming about the market. You start by buying yourself some breathing room. You save the first $1,000 fast, not elegantly, not perfectly fast. Then you push toward 1 month of expenses. Then you push toward 3 months. If your job is stable, your skills are portable, your household is resilient. Maybe that is enough for now. If your income is volatile, your industry is fragile, your household depends on one paycheck, or your life has a history of unpleasant surprises, then you probably need more. What matters is not memorizing a slogan. What matters is understanding why the bucket needs this patch before you do anything glamorous. Even a modest reserve changes your behavior. The source material cited research that people with at least $2,000 in emergency savings scored materially better on financial well-being, with a 21% boost relative to those with none. That number matters not because $2,000 makes you rich, But because the first layer of pressure in the bucket changes how you think Fe-Felicite. Fe turn 13 file 0 Fe once. That first hole is patched. You turn to the leak that laughs at amateur investors every single month. High interest debt. This is where I lose patience. There is no elegant way to say it. If you are carrying debt at rates that are substantially above what a reasonable long-term investment might earn after taxes, you are not in an investing phase. You are in a leak repair phase. You are trying to outswim a current you should have turned off first. People hate hearing that because debt payoff is not sexy. It does not let them fantasize about extraordinary upside, but a 22% credit card rate is not a, maybe it is not a prediction. It is a guaranteed drain. It is a hole drilled through steel. The source logic uses a very practical threshold of roughly 8% or more as the zone where debt deserves to be treated as a serious leak, while acknowledging that market conditions can shift the exact line. The principle is simple when the hole is draining faster than your likely after-tax returns can refill it. Your first duty is not to chase upside. Your first duty is to stop the leak. Fe-Felicite Fe turn 13 file 0. Fe think about the absurdity. A person carries $5,000 of credit card debt at 22%, makes minimum payments, and then asks whether they should buy a growth stock. That is like scooping water into the bucket with one hand while using the other to cut a larger hole with a drill. Mathematics is not sentimental. A guaranteed saving on 22% interest is a guaranteed return equivalent to 22%. There are not many honest opportunities in finance that will hand you that kind of certainty. The market offers possibility, debt payoff offers relief. In the early game, relief is often the superior asset. If you follow that $5,000 debt example long enough, the interest bill could approach $2,800 over 5 years on minimum payments alone. That is not investing friction. That is a predator living under your sink, drinking the bucket dry while you browse stock tickers on your phone. Fe-Felicite Fe turn 13 file 0. Fe, and this is where a lot of people go wrong emotionally. They underestimate the dignity of fixing leaks. They think patching the bucket is a lower status move than buying assets. It is not. Patching the bucket is how adults create the ability to buy assets without self-sabotage. Now, there is one exception that deserves to be pulled out of the pile because it is too powerful to ignore. Employer match. I want you to understand this clearly. If your employer offers matching contributions on retirement savings, that is not some little perk you think about later. That is a free money valve attached to your bucket. You open it first, or you are telling me you are comfortable walking past guaranteed value because it is not emotionally exciting enough. If your employer matches 50 cents on the dollar up to a limit, or dollar for dollar up to a limit, that immediate gain is extraordinary. The source example describes contributing $3,000 on a $50,000 salary to capture a $1,500 match. That is an immediate 50% return before any market growth enters the picture. In many cases, it makes sense to claim the full match even before high-interest debt is completely eliminated because the free money valve is simply too generous to leave closed. Fe-Felicite Fe turn 13 file 0 Fe. But notice what I said, claim the full match, not max everything, and ignore your debt. Not pretend free money solves a broken bucket. Just enough to open the valve all the way, then go back to the leak. This is how disciplined people think. They do not let one good opportunity become an excuse for disorder. They take the match, then they continue repairing the bucket. If there is a vesting schedule, know it. If you intend to leave the job soon, understand the rules, but do not use complexity as an excuse for laziness. Too many people leave real value on the table because they prefer the fantasy of a hot investment to the certainty of a matched dollar. By now you have done something most people never do. You have created a cash buffer, you have attacked high-interest debt, you have captured free money where available. That means the bucket is finally beginning to hold pressure. Now the next leak becomes visible, and it is quieter, which is exactly why it is so dangerous. Tax drag. This is one of the great silent leaks in wealth building. Most people think only in terms of return. They ask, what can I make? They should also be asking, what is being siphoned off before compounding? Ever gets a fair chance? When you earn interest, dividends, or capital gains in the wrong account, the tax man does not always wait politely at the end. Sometimes he takes his sip along the way. That lowers the pressure inside the bucket year after year. Not dramatically enough to make headlines, just steadily enough to keep ordinary people ordinary. That is why, after you have the basic pressure structure in place, I want you thinking about tax shields before you get seduced by unrestricted brokerage freedom. This is where many people get the sequence backward. They rush into taxable accounts because taxable accounts feel grown up and flexible. They tell themselves they want access and options. What they really want is the stimulation of movement. Flexibility feels like power. In many cases, it is just another leak with nicer packaging. The first major tax shield after the employer match is often the IRA. I like the IRA because it usually offers more control and often lower fees than the typical employer plan. Many workplace menus are full of mediocre options wrapped in fees that quietly nibble at the waterline every year. That is another leak people ignore because fees are invisible. But invisible does not mean small. If termites eat your floor one bite at a time, you still end up standing in a damaged house. In 2026, the IRA contribution limit is $7,500 with a higher catch-up amount available for those age 50 and older. That is not 10 million number. It is a protected chamber inside the bucket, a place where compounding has a better chance to operate without constant interference. Phasite Fay-Turn 967,461 search, 0 Fay-Turn 967,461 search, 5 Fay, and then comes the tax choice that confuses people far more than it should. Traditional or Roth pay taxes now or pay taxes later. You can turn that into a philosophy seminar if you want. I do not recommend it. Here is the simpler frame. If you are in unusually high earning years and likely to be in a lower bracket later, the traditional route can be sensible because the immediate deduction matters. If your current income is low and your future earning power is likely to rise, the Roth route can be sensible because paying a lower tax rate now may be a bargain. The problem, of course, is that people speak about future tax policy as if they possess divine access to Congress and the economy. They do not. That is why tax diversification has a lot of appeal. Having some money in each system gives you options. Options matter because retirement is not just a pile of money, it is a sequence of withdrawals, tax decisions, and control. Control is one of the highest forms of wealth. A full bucket with no flexibility is still less valuable than a well-structured bucket that lets you choose when, where, and how to pull water out. Then we arrive at what may be the most underappreciated patch in the entire sequence. The HSA. If you qualify for one through a high-deductible health plan, you should take it seriously. Not casually, not eventually. Seriously. Most people do not understand what makes the HSA special. They think it is just a medical side pocket. It is not. It is one of the rare places in the code where the bucket gets help from 3 different directions at once. Contributions can be deductible, growth can be tax-free, qualified medical withdrawals can be tax-free. That is a rare triple shield. In 2026, the HSA contribution limits are $4,400 for self, only coverage and $8,750 for family coverage, with an additional catch-up contribution for eligible individuals, age 55 and older. That makes it one of the most efficient protected chambers in the system for people who qualify. Phasite Fay-Turn 967,461 search, 1 Fay-Turn 967,461 search, 7 Fay-Turn 967,461 search, 9 Fay, but the real edge is behavioral. Most people use the HSA like a transaction account. They put money in, they spend it, they move on. That is understandable, but it leaves a lot of power on the table. If you can afford to pay current medical expenses out of pocket, the HSA can be left invested. You keep the receipts. You preserve the right to reimburse yourself later for qualified expenses. That means the bucket can hold and grow protected water for years while life goes on. This is not a gimmick. It is the kind of structure that looks boring to the impatient and beautiful to the rational. Medical spending in later life is not a hypothetical. It is a near certainty. A protected pool of capital reserved for that category can remove one of the most corrosive leaks from the retirement bucket. After age 65, the HSA becomes more flexible even for non-medical withdrawals, though the tax treatment changes. The point is not that it becomes magical. The point is that it gives you another chamber of control in a life stage where control is often lost first in health and then in finance. Phasite Fay-Turn 967,461 search, 7 Fay-Turn 967,461 search, 17 Fay. Once that chamber is addressed, you return to the larger employer retirement plan and keep filling the protected part of the bucket in 2026. The basic 401k elective deferral limit is $24,500, with additional catch-up contributions available for older participants. If you have reached this point in the sequence and can keep going, you are no longer playing the same game as the average person. You are not just saving. You are building layered pressure inside a protected system that can hold water for decades. Phasite Phayturn 967,461 search. 0 Phayturn 967,461 search. 8 Phayturn 967,461 search. 10 Phay. The reason this order matters is not because each account is cute and special. It matters because every protected chamber you fill before moving to the next one reduces friction. Lower taxes, lower fees, employer help, stronger buffers, lower behavioral panic, less forced selling. Those are not side details. Those are the reasons compounding survives contact with real life. Now we can finally talk about the place most people want to start. The taxable account. Notice how long it took to get here. That should tell you something. The taxable account is not evil. It is useful. It can be a bridge. It can be flexible capital. It can fund early retirement before other accounts are accessible. It can help with a future down payment. It can be left to heirs with meaningful basis advantages. It has a legitimate role. But if you run there first because it feels more exciting, you are telling me you prefer the appearance of investing to the architecture of investing. Taxable money has fewer walls around it, and people mistake that for freedom. Sometimes it is just exposure. Every dividend can create tax drag. Every gain you realize may invite a tax bill. Every act of impulsive trading turns the bucket into a little fountain for the IRS. The source material uses a striking example. Invest $10,000 a year for 30 years at 7%, and the tax advantage structure can end up far ahead of the taxable structure. Once you account for the friction of taxes along the way, the exact result will vary with assumptions. But the principle is iron. If the bucket keeps springing small leaks every year, the final waterline will be lower than you hoped. Phay file a site Phayturn 13 file 0 Phay. This is where people reveal what game they are really playing. The amateur sees the taxable account and thinks, now I can speculate. The adult sees the taxable account and thinks, now I can extend my system. Those are not the same sentence. If you still have a hole lower in the bucket, the taxable account becomes a toy. If the lower bucket is already repaired, the taxable account becomes a useful overflow channel. This entire sequence is really about identity, worker or owner, impulse or structure, excitement or pressure, noise or retention. Most people want to feel the emotion of ownership before they earn the discipline of ownership. They buy the language first. They buy the app first. They buy the market story first. They buy the fantasy first. They do not buy resilience first. That is why their bucket never rises. They pour income into debt. They leak cash because they never built a reserve. They ignore the free money valve at work. They underuse tax shields. They overpay for mediocre funds. They turn taxable flexibility into taxable chaos. Then they say the game is rigged. The game has many rigged features, but disorder is still disorder. And I want to say something that most people need to hear more harshly than they are accustomed to hearing it. You are not too poor for order. You are not too busy for order. You are not too late for order. What you may be is too addicted to stimulation. That is the real problem for a great many people. They would rather research 10 stocks than build 1,000. Dollar buffer. They would rather debate market valuations than confront a credit card statement. They would rather ask whether the Roth beats the traditional in some abstract future tax scenario than admit they have never even taken the full employer match. They want advanced moves because advanced moves flatter the ego. But wealth does not care about your ego. Water does not care about your ego. If the bucket leaks, the bucket leaks. The beautiful thing about respecting sequence is that it compounds beyond the numbers. Once your emergency reserve exists, your nervous system calms down. Once your expensive debt shrinks, your monthly pressure improves. Once the match is captured, the bucket fills from 2 directions instead of 1. Once tax shields are used properly, the waterline holds better. Once your system is in order, every future dollar works harder because it is entering a better bucket. This is why order beats brilliance for ordinary people. Brilliance is unreliable. Order is repeatable. Brilliance is seductive. Order is profitable. Brilliance makes for better conversation. Order makes for a better retirement. I have no issue with ambition. I like ambition. I like ownership. I like disciplined risk. I like rational investing. But I have no respect for skipping the sequence and calling it sophistication. Sophistication is not buying an options contract before you have an emergency fund. Sophistication is not maxing a brokerage account while carrying a balance at punishing interest. Sophistication is not debating ETFs while ignoring the tax shield sitting in an HSA. Sophistication is not performance. Sophistication is leak control. You do that long enough, and something important happens. Your bucket stops behaving like a crisis container and starts behaving like a compounding system. That is the transition almost everyone wants and very few are willing to earn. A crisis container is always on edge, one event, and it empties, one surprise and it leaks. One bad habit and it cracks. One tax mistake and it drips. One debt cycle and it rattles around half full forever. A compounding system is different. It is quieter, it is less dramatic, it is more adult. It does not need constant adrenaline. It needs pressure retention, it needs time, it needs the absence of stupidity repeated often enough to become visible as success. And once you see the bucket this way, a lot of ordinary financial behavior becomes impossible to admire. Carrying high-interest debt while praising your portfolio becomes embarrassing. Ignoring a match becomes embarrassing. Using a taxable account as a toy while protected accounts sit half empty becomes embarrassing. Talking endlessly about investments while having no reserve becomes embarrassing. That embarrassment is useful. It is the moment you stop acting like a tourist in your own financial life. I do not care if the sequence feels boring. I care whether it works. The truth is that most fortunes are not ruined by one theatrical error. They are weakened by persistent leaks that people defended because those leaks felt normal. They kept a little debt because everyone does. They skipped the emergency reserve because it was not urgent until it was. They told themselves they would learn tax optimization. Later, they accepted fees because the percentages looked small. They treated flexibility as an excuse for disorder. And over time, the bucket never quite held enough pressure for the waterline to become freedom. That is the real prize. By the way, not a number on a screen, freedom. Freedom is a bucket that finally holds. Freedom is not being forced to sell because life happened. Freedom is not sending 22% to a lender for the privilege of pretending you are progressing. Freedom is opening your statement without dread. Freedom is knowing your protected chambers are filling while the world shouts about whatever shiny thing is trending this week. Freedom is the ability to refuse bad jobs, bad debt, bad timing, bad taxes, and bad behavior, because your bucket can absorb reality without collapsing. If you want a simple summary, here it is. Patch the cash hole, patch the debt hole, open the free money valve, fill the protected chambers, only then use the flexible overflow. That is the sequence. But I do not want you to treat that summary like another slogan to forget by dinner. I want you to use it like an X-ray. Look at your life tonight and ask yourself one question: where is the biggest hole in my bucket right now? Not the most interesting hole, not the most sophisticated hole, the biggest one. The one actually draining pressure. Is it the empty reserve? Is it the credit card balance? Is it the employer match you never claimed? Is it the tax shield you ignored? Is it the flexible account you are misusing because it makes you feel like an investor? Pick the largest leak, patch that one first, then patch the next, then the next. That is how adults build wealth. Not by pouring harder into broken buckets, by becoming the kind of person who cannot tolerate leaks. And that is the test. Not whether you can name the next great investment, not whether you can impress strangers with financial vocabulary, not whether you can post a portfolio screenshot. The test is whether you are willing to do the boring repair work long enough for the bucket to hold. Because once it does, compounding stops feeling like theory. It starts feeling like power. And if you refuse to do that work, then understand what you are choosing. You are choosing to stay in a life where the water never rises high enough to buy calm. You are choosing motion over progress. You are choosing stimulation over structure. You are choosing to keep pouring your future into holes that were visible the whole time. The market can do many things for you over a lifetime. It cannot save you from a broken bucket you insist on defending. That part is your job. Do it in the right order, and the waterline changes. Ignore the order, and you can spend years calling yourself an investor while the bucket stays half empty. That is the door. On one side is the thrill of pretending. On the other side is the discipline of repair. Choose the side that holds water.